Hi there, I'm Sup Day. I'm a chartered accountant and I'm hoping to do some tutorials in financial accounting and reporting, and this might help students who are sitting for accounting examinations. And our objective in this tutorial is to prepare a group cash flow statement from financial statements. In my first video on cash flow statement, I discussed the format and content of a cash flow statement using a PLC or a public limited company as an example. This is the second video on cash flow statement where we attempt a question requiring the preparation of a cash flow statement. Before we look at the question, what I hope to do is to have a quick review of the main components of the cash flow statement. Right, the cash flow statement classifies all cash transactions in an organization into three kinds. One is the net cash from operating activities, and they deal with items that appear in the income statement, such as revenue and expenses, but they are dealt with in a cash basis. The net cash from investing activities, the net cash from the financing activities deal with items that appear in the balance sheet. The investing activities relate to the acquisition of non-current assets, and the financing activities relate to how those assets, non-current assets, and also working capital, has been financed. And finally, all three are netted off to have what is called either a net increase or a decrease in cash flow in the year. And then we have the cash and cash equivalents at the beginning of the year. Cash and cash equivalents comprise cash balances and bank deposits with an ongoing maturity of 3 months or less, and that will give us our final balance at the end of the year, which is which again can be negative or can be positive. Examination questions require the preparation of cash flow statements, provide you with extracts of the income statement and the balance sheet, and this is called the indirect method. In the next slide, we will review a question on the preparation of a group cash flow statement. So here is a question that requires the preparation of a group cash flow statement. I suggest you pause the video here and go through the information in greater detail. But what we have here is extracts from the income statement. And as I said, most of the entries here would find their way into the operating activities of a cash flow statement. On the balance sheet side, the current assets and the current liabilities or changes in working capital, they also would go to the operating activities in a cash flow statement. The non-current assets or the acquisition of assets go to the investing activities in a cash flow statement, and the financing of these assets, if you like, goes to the financing activities of the cash flow statement, which are through the issue of equity and perhaps more loans. In the next slide, we are provided with more additional information relevant to the question. In this slide, you're given additional information to help you to prepare the cash flow statement. I suggest you pause the video here and go through this information in greater detail. As I said, very briefly, note number 1 deals with the acquisition of a subsidiary, which is Melbourne Limited, and we may have to prepare a cost of control account or a goodwill account relating to this acquisition. Note number 2 relates to how the consideration was satisfied, which was by shares and cash, but no figures are given, so we'll have to work out what the actual consideration was. Note number 3 deals with items that relate to the depreciation as well as to the disposal of equipment. Again, there is some information missing here in terms of what was actually received from the sale of this equipment. Note number 4 tells you that the intangible assets comprises the goodwill on the acquisition of the subsidiary. So again, by reconciling the opening and closing, we may find out if there has been any impairments of goodwill. And finally, note number 5 deals with dividends paid to the shareholders as well as to the non-controlling interest. In the next slide, we will discuss the approach in answering questions that require the preparation of a cash flow statement. The suggested steps in preparing a cash flow statement in an exam setting. As you know, the cash flow statement has 3 components. So start with the cash flow from operating activities. In the diagram attached, you can see that we start with the group profit before tax taken from the income statements and then adjust for the non-cash adjustments. Now there are many non-cash adjustments to be made in arriving at the cash flow from operating activities, and these are things like depreciation, impairment, gains or losses on sale of tangibles, gain or loss on sale of subsidiary, share of associated profits. And you may have to reconcile the opening and closing balances in the non-current assets to identify any impairment gains or losses on disposal of non-current assets. Once you've done that, you then prepare the movements in working capital, and by that I mean inventory, debtors and creditors between the beginning of the year and the end of the year. And this will indicate whether there have been an increase or decrease in the 3 components of working capital. Finally, prepare the taxation account, and this will indicate if there's any actual tax paid. IAS 7 does not specify how to classify cash flows from interest paid and interest received. Many PLCs now treat interest paid as a financing activity similar to dividends, and interest received is treated as an investing activity similar to dividends received. In the next slide, we will prepare the cash flow from operating activities for Salton PLC. So let's look at Salton PLC. We're going to compute the cash flow from operating activities. We start by entering the information that is already provided in the question, for which we have to do no workings. And these are the profit before tax taken from the income statement, which if you look at it, it's 420,750, and we put that in the cash flow statement. Share of associated profits 53,650. Depreciation, which is in note 3 of the question, that's 235,600. Profit on sale, again in note 3 of the question, given as 2,700. Our next job is to prepare the movements in the non-current assets. Particularly, we'll take one, which is intangible assets, simply because there could be a goodwill write-off. So we are provided, if you like, here, or we are given in the balance sheet the opening and closing balances in the non-current assets, and we should use this information to prepare the intangible assets account. So the opening balance is 135,400 Melbourne goodwill, which is again given in note 1 to the question. So that's your opening balance, the goodwill that was derived when they purchased this company, and we ended up from this total of 158,800, the closing balance, which is taken from the balance sheet given, is 142,300. And if we take the difference between the two, in other words, we have a lower closing balance than 158,800, and this suggests that there has been some goodwill impairment, which is 16,500. And we then, if you like, add it to the operating profit, because in the income statement this amount would have been a deduction. Next thing we look at is we compute the changes in working capital. Next, we're going to prepare the movement in working capital, which is inventory, debtors, and creditors, between the beginning of the year and the end of the year. This will indicate whether there has been an increase or decrease in the three components of working capital. So here's the data taken from the balance sheet, and we slot in the figures. So the opening balance, 2019 for debtors, is 61,300. We've got Melbourne, which was acquired during the year, and we have to add in its working capital on debtors, which is 12,300. We add it up, and then we take away the closing balance taken from Salton PLC of 53,400. Now, this is a lower figure than 73,600. So what it means is that we have an inflow of cash of 20,200 for debtors. So it's a decrease in receivables, which increases the cash flow, 20,200. And we then work out the figure for creditors, the opening balance again, 73,000. Then we got Melbourne, 18,700, taken from note 1. Total that up, take away the closing balance, which is 61,200, a lower figure. So effectively we have an outflow of cash simply because maybe we have paid the creditors too quickly, and that is a decrease in payables, which is an outflow, and the next figure gives us 10,300, which is then cash generated from operations of 606,200. Finally, we prepare the taxation account, and this will indicate the actual tax paid. Again, we've got the data here, and we've got the opening and closing balance on the tax payable account, and we've also got the tax payable in the year of 31st of March 2020, and this will help us to write up the taxation account to find out the actual tax paid. So again, the opening balance, 69,000. The tax payable from Salton profit and loss account or income account, which is 72,000. We add them up, and then we take the closing balance, which is 85,000. So effectively the difference is a tax paid of 56,000, and we can slot that into the cash flow statement for operating activities, giving us a net cash generated from operation of 550,200. In the next slide, we will go through the information required in preparing the cash flow from investing and financing activities. Investing activities deal with the acquisition and sale of non-current assets. A group cash flow statement will also include the cash consideration paid for the acquisition of associates and subsidiaries. Dividends received from associates and interest received on cash balances are included here. Financing activities. Entries mirror the equity and liability side of the balance sheet. Proceeds from share issues are included here. Loan transactions such as receipts and repayments are also included here. Dividends paid to shareholders and non-controlling interests are also included here. Interest paid on loans are also included here. In the next slide, we will prepare the cash flow used in investing activities for Salton plc. Alright, cash flow generated from investing activities. Now in note 3, in 2020 there was a disposal of equipment with a carrying value of $74,200 and a profit of $2,700 was made, but no mention of the cash proceeds. So prepare an asset disposal account to ascertain the cash proceeds from disposal. So here we go. PPE carrying value that was disposed of was $74,200. We made a profit of $2,700 on the sale. And if we add this together, we should get the cash proceeds on sale, which is $76,900. Now we can insert this in our cash flow statement under investing activities. Right. Secondly, we have to prepare a reconciliation of the opening and closing balances of the PPE account, purchase plant and equipment, as we need to ascertain if there was any cash purchases of machinery in 2020. Again, we have to see what data we need to use. We have the balance sheet for the 2 consecutive years, and we're in a position now to work out if any cash purchase of machinery was made in 2020. So start with the opening balance, which is given as $768,900. We also, if you like, have to take away the depreciation, which is given in note 3, $235,600. We also have to take away the carrying value of the asset disposed, which we just did on the disposal account, of $74,200. And finally, we have to add in the PPE that was acquired when we acquired Melbourne Limited. So in note 1, the PPE value was $235,700 plus the $40,000, which is the increase in fair value of the land, and we end up with a total of $275,700. This is all totaled up, and we then take away from that the closing balance, and you can see here that the closing balance is higher than the opening balance, which suggests that there was some acquisition. So the difference represents the cash purchase of PPE, which is a cash outflow, $99,700, and we can insert this in the cash flow statement. So the purchase of assets, $99,700 as a deduction. Finally, we can look in the next slide. We're going to continue with the cash flow from investing activities. Right, continuing with our cash flow generated from investing activities, if we look at the data set of Salton plc's group balance sheet between 2020 and 2019, we see an item called investment in associate, which the balances differ between 2020 and 2019. So we have to prepare a reconciliation of the investment in associate balances between 2019 and 2020, as this will indicate if any dividends from associated was received in 2020. We can start with the opening balance in 2019, which is 227,500. We add the share of associated profits, which we get from the income statement of Sultan PLC, which is 53,650. We get a grand total of 281,150. We then offset that against the associate balance against 2020, which was 268,000. And this difference, if you like, represents the dividend from associate, which is a cash inflow of 13,150. We can now insert this in the cash flow statement under investment activities and proceed on to the next item. Now in the question states that Sultan acquired Melbourne Limited on 1st of October 2019, and the acquisition was satisfied partly by shares issued at a premium and cash. Note 2, what we have to do is to prepare an acquisition account to ascertain the exact shares that was issued and the amount of cash that was also paid. So start with the acquisition. Net assets acquired on 1st of October, which we get from note 1, which is 230,600. We then note in note 1 there was an increase in fair value of the land, which was 40,000. We're also given the value of goodwill in note 1, which is 23,400. And that gives us a grand total of 294,000. What we have to do now is to work out the respective shares for the non-controlling interest and the parent shareholders. So start off with the non-controlling interest. They have which is equivalent to 30% because the share capital is 100,000 and the parent company shareholding amounts to only 70,000, so it's 30%, and we multiply that against the assets taken over, excluding goodwill, which is 230,600 plus 40,000, and that gives us 81,180. We also note that shares were issued by Sultan PLC for the acquisition, so we take the balances for both years, which is 500,000 for 2020 and 400,000 in 2019, and that gives us 100,000. Same with the share premium account, 100,000 in 2020 and 50,000 in 2019 give us a balance of 50,000, and if we add that up we come to a total of 231,180. The difference, if you like, represents the cash consideration. So we put the totals at the bottom and find out the difference, which comes to 62,820. Now in note 1, there was a cash balance of 1,300 in Melbourne Limited on 1st of October 2019. And this is deducted from the cash consideration payable of 62,820. So the actual acquisition cost was 61,520. And that gives us a cash outflow in investing activities of 71,170. In the next slide, we'll compute the cash flow from financing activities. To complete the cash generated from financing activities, we need to look at the equity and liability side of the balance sheet. Now, there are two items there that we haven't reconciled, or we have different balances. The first one is the retained earnings. So we have to reconcile the opening and closing balances on the retained earnings to ascertain if any dividends were paid to the shareholders of Sultan PLC. And there is the non-controlling interest, where if you look at it within the 2 years 2020 and 2019, the balances are different, again we have to reconcile the opening and closing balances in the non-controlling interest to ascertain if any dividends were paid to the non-controlling interest. Right, let's start with the retained earnings. We start with the opening balance taken from the balance sheet in 2019, which is 370,960. We add the group share of the profits, or the parent share of the profits, and that is included in the income statement of Salton PLC, which is 283,840. We total that amount, which gives us 654.80, and we then, if you like, offset it against the balance in 2020, which is 329,800. So there is a difference, and this difference is really can be attributable to the dividends paid to the parent shareholders, which is £325,000. We can now insert this figure in the financing activities in the consolidated cash flow statement, and once we've done that, we can then go on to reconcile the opening and closing balance in the non-controlling interest. So again, we start with the opening balance, 2019, which is 235,540. We add to it the share of the net assets of Melbourne PLC that is attributable to the non-controlling interest, which is 81,180. We add in also the share of profit attributable to the non-controlling interest at 31st of March 2020, which is 64,910. We add them all up. That gives us 381,630. We then compare that with the closing balance taken from the balance sheet of 2020, which is 229,000. And that difference, if you like, represents the dividends paid to the non-controlling interest, which is 152,630. We can again insert this on the financing activities side of the consolidated cash flow statement. We then total up the total of the financing activities, which gives us a cash outflow of 477,630. And once we've done that, we then net off the cash generated from operations, the cash generated from investing activities, and the cash generated from financing activities, which gives us a change in the cash equivalents in the year of 1,400. We then add it to the opening cash balance taken from the balance sheet, which is 5,400, and that gives us the closing balance at the year end, which is 6,800.